So good afternoon, ladies and gentlemen. I hope you've been enjoying the Dubai Forex Expo so far. I'm here to speak about gold. What I'm holding here is a British sovereign gold proof coin from 1981. It contains precisely 0.2354 troy ounces of gold. Of course, Dubai is no stranger to gold. The city, often called the City of Gold, has a rich history deeply intertwined with the precious metal. From the famous gold souk with its dazzling displays to the Dubai Gold and Commodities Exchange, gold is an integral part of Dubai's identity and economy. In fact, the UAE's gold trade was valued at over $40 billion in 2023, highlighting its significant role in the global gold market. In the year 2000, the melt value of 1 ounce of gold was approximately $285. This morning, it's hovering around $2,650. Now, you might be tempted to say, wow, gold has become nearly 10 times more valuable during that period. But I challenge you to consider a different perspective. What if gold hasn't become more valuable at all? What if instead it's currencies, our fiat currencies, that have become less valuable? You know, gold just is. It doesn't promise a yield. It doesn't claim to grow or innovate. Its essence has essentially remained constant through time. While we often hear about the rising price of gold, what we're really witnessing is the declining value of fiat currency. So let's look at some stark figures. Since 1971, when the dollar convertibility to gold was abandoned or temporarily suspended, as they claimed, the US dollar has hemorrhaged over 98% of its value relative to gold. But it's not just the dollar. The British pound sterling, the euro, and other major currencies are all on the same downward spiral. This is, of course, due to a number of reasons, but primarily due to central banks and their expansionist monetary policies. So this chart illustrates the simultaneous rise of gold prices, the US M2 money supply, and the S&P 500 index over the last 6 decades. While each of these metrics is influenced by unique factors, their concurrent upward trend highlights some interesting relationships. Firstly, the expansion of the money supply reflects increasingly accommodative monetary policies, including central banks and their quantitative easing, and of course, a very long period of low interest rates. The S&P's growth represents not just economic expansion and rising corporate earnings, but also the effects of share buybacks, which are incidentally also influenced by low interest rates. While gold's ascent does not always correlate directly with the other two, it underscores its role as a store of value amid currency debasement and economic uncertainties. Of course, short-term disconnects can occur and do occur, but they're short-term. So actually, this brings me to a fascinating phenomenon, which I witnessed firsthand. During the COVID-19 pandemic, I was a bullion dealer in Singapore, so I was selling physical precious metals. And if you recall, at the beginning of the pandemic, the price of precious metals, gold, platinum, palladium, and particularly silver, was falling with risk assets. The futures market, which often dictates the official price, was showing a sharp decline, and silver in particular got as low as the $10 handle. But in reality, on the ground, as a bullion dealer, I saw a completely different story. Customers were lining up, eager to buy any physical metal they could get their hands on. And in fact, when silver hit that $10 handle, bullion dealers, including myself, simply refused to sell. Why? Because we knew that the paper price had essentially become meaningless. And the disconnect was staggering. In fact, just to give you some feedback, refineries were backlogged with orders for 6 months or more, yet the paper price kept falling. And it was as if we were watching two entirely different markets. So the situation was essentially like a coiled spring. I knew the tension between the paper prices and physical demand could not last forever. Either the paper price would need to snap back with tremendous force, or we'd see a historic decoupling of paper and physical prices. And truth be told, we saw a super sharp snapback in the paper prices. And this experience underscores a crucial lesson. In times of crisis, the paper market can become very detached from physical reality. And it's a vivid reminder of the importance of understanding both the paper and physical aspects of the gold market. So history has shown us time and time again that gold shines brightest in the darkest economic times. During the hyperinflation of the 1920s Germany, those who held gold preserved their wealth, while others saw their savings evaporate overnight. More recently, during the 2008 financial crisis, when we saw the S&P 500 plummeting 37%, gold climbed 5%. So, of course, it's not always a perfectly inverse relationship, but gold has consistently proven its worth as a crisis hedge. Now, I'm not here to predict all doom and gloom, but let's face the facts. Global debt levels are at record highs, and the potential for significant economic disruption is real. So gold offers a form of financial insurance against such scenarios. This chart from the World Gold Council shows total gold demand reached a record high in the second quarter of 2024. And we have another chart here which shows the S&P to gold price ratio over the past century. And it actually reveals a fascinating cyclical relationship between these two asset classes. Imagine a strategy where you essentially alternated between holding gold and holding the S&P 500, shifting to gold when stocks look relatively expensive and back to stocks when gold was relatively overvalued. So even if you didn't have perfect timing, but patiently followed this approach over these long cycles, it would have yielded remarkable results. And actually, Mike Maloney, in his book, shows, I think, from $25, if you just, switched between gold and the S&P and back again, that would have made, I think, north of 14 million over the last 100 years. So this long-term perspective demonstrates that gold isn't just a static store of value, but a dynamic counterbalance to equities and also other asset classes. So it underscores gold's crucial role in terms of portfolio diversification, and it shows that the real power of gold emerges when viewed in relation to other assets. So of course, the gold market is evolving, and we are seeing gold-backed cryptocurrencies, we're seeing tokenized gold, and we're also seeing improved methods for digital gold trading as well. And these innovations are making gold more accessible and liquid more than ever before. But I think, remember the lesson from our COVID experience, there's no substitute for physical ownership. In times of crisis, people don't want paper promises, they want the real thing. As we conclude, let's come full circle. Remember this coin. In a world of endless financial innovation and rampant money printing, this remains unchanged. It still looks exactly the same when it was pressed back in 1981. Actually, incidentally, it's the year of my birth, so it's a testament to gold's enduring value. And of course, you must have realized by now, I'll confess, I'm a bit of a closet gold bull. Not because I expect it to outperform every asset. Cryptocurrencies might see a lot more explosive growth, and certainly there'll be stocks which undoubtedly have their day. But in essence, gold represents more than just wealth preservation. It's about maintaining optionality in an uncertain world. So it's about having a portion of your wealth essentially outside of the traditional financial system, immune to bank failures, currency collapses, or digital glitches. So as the saying goes, he who has gold makes the rules. And in our world of fading currencies and financial uncertainty, gold isn't just a relic of the past. I think we all know this in Dubai. It's a strategic asset for the future as well. So I'll leave you with this one question. In a financial landscape that's constantly shifting, what is your golden strategy, and how will you navigate, or how will you use this timeless asset to navigate the challenges and opportunities that lie ahead? I'll end it there. Thank you for your attention, and may your financial decisions be as solid as gold. Thank you.